welcome to Investing for Freedom channel, and I'm Joanne. In our last video, I recommended focusing on intrinsic value of asset to lower the investment risk. Let's talk about the principle of measuring intrinsic value of various assets today. I often use dam and the water storage behind the dam as a metaphor for an asset and the value. The height of the dam is the price of the asset, but the water behind the dam is the value of the asset. Although we use US dollars to measure the price and value, but actually those two cannot be measured by the same metric. The height of the dam can be measured by meter or feet, but the volume of water is three-dimensional, so they're not in the same page. To make this easier and make it an apple-to-apple comparison, we can try to figure out the water level rather than the volume. The water level is largely determined by the volume of the water, so the water level can represent the value of the asset more easily. Water level will be determined by three factors. First, the volume of the water in the first place. Second, the water outflow. And lastly, water inflow. Let's start with the easy one. If there is no water flows whatsoever, then the volume of the water will remain the same. It means the value of the asset remains the same. Gold will be the typical example. In this case, we can simply compare the value with the money supply to evaluate the current price. If the water outflow is similar to the water inflow so that the balance remains, then it is called steady state. The value largely remains unchanged. Real estate with steady rental income and dividend aristocrats would be such examples. If the value of asset changes, it's called dynamic state. Most of the states will fall under this category. In this case, the water level is changing and we need to figure out which water flow would best represent the changing water level. For example, value of Tesla has grown rapidly during the past few years. Which water flow will best represent the rising water level of Tesla? I think the top line, sales revenue of Tesla, represents the rising value of Tesla. In case of Bitcoin, we cannot really see the water outflow coming from the Bitcoin dam. So some people criticize Bitcoin has no intrinsic value. But there are many investors pouring their money and time into the water of Bitcoin. So in Bitcoin's case, although we cannot really see the water outflow, but we need to look into the water inflow to estimate the rising level of the Bitcoin. So for each asset that we're looking into invest, we need to find the water flow that best represents the water level behind the dam. Once you have chosen the representative water flow, then we can accrue the water flow to estimate the value. I call this accrual of nominal cash flow. Warren Buffett said intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. This is called discounted cash flow, DCF, which is one of the most widely used valuation tools. We need to determine three factors to use DCF: future cash flow, discount rate, and remaining life. Key weakness here is that future cash flow projection is too subjective, and so is the discount rate. So here, let's think out of the box. Why can't we use the cash flow from the past instead? If we can secure long enough data, the past cash flow can also represent the present value of the asset with the factual data. Then what about the discount rate? Because we don't know which discount rate to use, let's not use the discount rate. By not using the discount rate, or by setting the discount rate to 0, I'm actually estimating the value in a more conservative manner. So our new DCF comes out like this. If we can get long enough past data of cash flow, then we can simply add those past cash flow because the discount rate used here is 0. If you're doing this in an Excel spreadsheet, you can simply choose to add trend line, and it'll give you the value of the asset past and future. We can estimate the value of almost any asset that has serial data of cash flow by adding up the nominal cash flow of the past. The longer the cash flow data, the more accurate the estimate of the value will be. Typical examples would be the dividend aristocrats. Dividend aristocrats are dividend stocks that have raised the dividend for at least 25 years consecutively. Because these stocks have long cash flow data and quite stable dividend payout policy, this methodology works quite well. For example, if we add up all the past dividends of Johnson & Johnson and click Add Trend Line in the Excel spreadsheet, we can get the trend line of J&J's value as dividend machine. Because the R square is very close to 1, the trend lines seem to represent the actual data quite well. Then we can analyze how the actual price has moved compared to the trend line. And we can also conclude whether the current price is higher or lower than its current value. I'll stop here for today and I'll come back with more examples of valuing assets in dynamic state, such as Tesla and Samsung Electronics. Thank you for watching today.